Hello everybody, welcome to another update on the stock screener. Today I'm going to do a workshop on Argonaut Gold. I have never seen this company and I'm just going to find out if this is a good or a bad company. And it seems that this gold mine has actually held up very well and I want to know why. So this is going to be a very long video and it will show you the process of due diligence. So first off, 928 million is 723 market cap. Okay, it's a very large company. Let's take a look at the financials first. And we're going to look at 2020. Let's take the shareholder equity, 502. Revenue, 66. Then we have profit, 9.5. Yeah, let's just take. Okay, if you want both, no problem. 13.8. And then net income. So it has a loss, minus 9.5. Due to other income expenses and taxes. Okay, so let's go on to Q2. $504. So this shows you how long it takes to actually do due diligence. 57.9. Still a net loss. That's interesting that they have net losses. Revenue, costs, they have profits, but something is making this into a loss. Don't know what, but let's take a look at the notes. Liabilities. Not going to read this all, but apparently they have losses. And then Q3. Suddenly, the equity rises to 728. That's interesting. Why is the market cap so low? That's interesting. We only have 200 million liabilities, 300 current assets. So this should be very cheap. Okay, revenue. And we have net income. So you see, it's actually rising. Let's see what we get in Q4. $772. And rising some more. So the balance sheet is pretty okay. Is 319 minus revenue keeps increasing. Also increasing. Stable. Net income 14.2. Is actually 18. So numbers rise. Very good. Then Q1. 830. Actually, it's already above the market cap. The equity is above the market cap. This is already very cheap. I think we have a winner here. And I have not even seen how much the production is. $27. So as you can see, we have a profitable operation. Earnings keep rising. Q2. 860. And we're still above the market cap in equity. Look at it, how it rises. We like that. Revenue keeps increasing. I'm not sure why the gold price was not rising, but somehow they keep increasing. So this is the situation. So if we just look at the earnings, then we have around 25 million earnings per quarter times 4. That's 100 million earnings. So we have a PE of 7, which is a very good buy. Equity is at 860 plus 2 months of earnings that we have. So 877. So we are price to book value 20% discount. Very cheap. Just okay, what's the debt? The debt is, let's say, 320. There are provisions here, but there is long-term debt. But it's lower than equity. And also lower than current assets. So they are not in a liquidity problem. Shares outstanding, not that important, but let's take 310 million. Okay, so based on the earnings, this is already cheap. Now let's go to the production numbers. Okay, so the first one, El Castillo. Okay, so these are the amount of ounces. They have gold and silver. 14 million silver. That's about 140,000 gold. So let's add it to this. 800,000. 800,000. And then measured and indicated 1 million plus 1.1. Let's take 1.1. Invert 45. So they have 2 million ounces at El Castillo. And production is, let's say, between this and this. Well, actually, we need to look at the news releases here. El Castillo, 32663. Times 4 is 130,000 ounces of gold. right? And does this compare to this? Yeah, 130,000 is acceptable. At which cost? Do they say anything about that? Not really, but the guidance for the whole operation is 1247 AISC. Okay, 1247. Full year is higher. That's not good. Let's say 1300. That's not a good number. It's too high. Okay, let's go to the next asset, La Colorada. Production is 17288. 70,000 ounces. Let's see if that's correct. That's higher than in the previous years. That's weird. 70,000. How come this is so high? I have no idea, but apparently it's like this. How many ounces do they have? 100% ownership, also important. 453,000 ounces and 6 million. That's about 500,000. Indicated 10 million. That's 700,000. And 23. So that's 1 million ounces, 2 million ounces, that's 3 million ounces. So actually we need to know what's the mine life. Is total divided by production. "14 years mine life." That's good. So 17 years mine life. Is that correct? 70,000, 10 years, 700,000. Yeah, it's correct. That's a very high mine life. Typically, the gold mines are not that high. Okay, next asset. Luckily, they only have 3 assets. 100% was the other also 100%. Yeah. So here we have 954, 1161, 54. That's actually the largest deposit. 2 million ounces. Let's see the production. $13,798. Why does this have the lowest production with the highest mine life? That's not normal. I don't get this. They should be much higher in production. Okay. Let's take a look at the presentation. Do they have cash costs? Okay, so this is high cost, very high cost. If they increase production, that cost could come down, and this is also high cost. And what's this San Augustine? What's San Augustine? San Augustine. Oh, that's El Castillo. So that's this. So they actually have cash costs numbers here. But AISC is higher than the cash cost. About 20% higher. So they added about 200 to this. So I could just estimate that this is about 1,200 maybe AISC. La Colorada is 800. Florida is 1,300. And it's actually even higher. Maybe 1,500 now. Look at these numbers. So this is probably 1,000 let's say 1,400. So this is not a very good operation. So these are the production numbers. Looks very good. We need to have this data. Production is rising. So we have 63.7 production. AIFC was 1,300. And this is per quarter. So 254,000 ounces. So we can already calculate, let's say 60 my life, the EBITDA valuation, which is very important. This is the production times gold price 1780 minus AISC times multiple. So this company is worth 600 million and we're about 700 million. So it's a bit overvalued. So fair value is correct. And let's put this in here. So we have production AIC times 5 and gold price. So we have a valuation of 527. How come this is not the same? Oh, okay, this is not correct. Okay, so we have this number here. And then I saw that there was a new mine coming online in 2023. So 2023, something happens. Which means we need Magino. Let's see what this actually is. Do we have a feasibility study? Probably last year. Okay, Magino. So they started construction last year. Initial capital 321. 370 actually. That's pretty large capex. So hopefully something good happens with that. "17-year mine life. AISC 711. That's good. We have a lower cost project. Do they have technical reports? I want to know the production schedule. I'm not going to read all of this, but I'm searching for the production numbers. Okay, we have found it. So these are the production numbers. So they don't have a lot of production here, so I would take an average of, let's say, 120,000. 120,000 plus current production. So what's the AISC for 2023? So we have an AIC of 1,300 here, and the AIC here was 711. So we need to make an average of that. So what's the percentage production? 120 divided by total 30%. So the average of 30%, 30/70. So the AISC is this. And that's the 70%. Let's see if this works. 70% plus the AISC times 30%. That gives an AISC of 1,100. Okay. So when we take a look at this, that's the production in 2023 AISC. So we have the valuation of 1 billion. So we can go from 700 to 1.2 billion. That's a rise of 50%, 60%, almost 70%. So there is a lot of upside here. Let's take a look at the NPV. After tax, 288 at 1,250. NPV 5%, 288. Then 1,400 NPV of 422. Let's make a chart. They are making it difficult. Okay. Trend line. Units. Okay. So we are now here. So the NPV is around 700. 800. Let's say 800. Okay, so we have an 800 NPV, but with mine life of 17. So we need to divide by 3 to normalize it. And that means we have 266 value here. 266, but we need to know it is already financed. I know that they have already financed this project. Otherwise they wouldn't construct it. So, and the capital was 370. So we add this to the NPV because it's already financed and put into the market cap. So that would give us at least 1 billion divided by 3. So this is worth 300 to 400 million dollars. And what are the resources? 2.1. And measured and indicated. So they say inclusive of mineral reserves. In first 886. So how much do they have actually? Maybe it's easier to look at this here. 2.136. And 4.197. 886. So they do have an extra 4 million ounces. Because when you add this, it's 1. Yeah. So 4.2 and 886. So this is a pretty big deposit, which is almost in production. What's the mine life? 17. Let's check this. This divided by production, which is 120. There's a 60-year mine life. So if they put this into this category, then they have 60 years. That's a lot. So this is a very large deposit, which they can still increase production on. Okay. So what's the total? I want to know the total as well. And we can find this here. So apparently they still have this thing here, which are also very large deposits. I'm not going to take this into account because they are not in production yet. 6.8. Then 13,076, and these things I don't count. The silver, copper and silver I'm not going to count. This is a gold company. So 13,076. And 1170. So in total, they have 20 million ounces. 20 million ounces. I can't believe that. 7, 9. apparently they have a lot of it's the Maginot here, which adds 7 million, and then this 2.8 is also a lot. Cerro del Gallo has a lot of reserves, a lot. So these are projects that can add to the value. So let's do a calculation of how much this should worth. 20 million. If you just think that this is an explorer, you do this times 30, then we would have already a 600 million valuation. So this company is actually trading like an explorer. It's unbelievable. It should be already worth 600 million based on these reserves, 20 million. This is very cheap. And this is already in production. 7 million ounces. If you have a production company, you probably would add a 100th valuation to the resource. So that would be worth 700 million. So actually this market cap should already be worth Maginot. And then we add these things here, which have incredible mine life, all of them. And they have a PE of 7. So it can only get better and better. And in 2023, this company can double in earnings. So this is an easy 80% upside if you wait for 1 year, because 2023 is really close and the earnings will probably double because AISC goes down by 200 points and production goes up by 30%. Actually, how much percent is this? This is 120. Actually, by 50% production. So this is a typical example of value creation by increasing production by 50% and reducing costs by 20%. So it is an equivalent of a doubling of production, and that's why this will go up by 2-fold in a year time. Okay, so this company is on my watch list. This production is increasing, that's also good. At least it's not declining. And this is coming online next year with great mine life. 16-year mine life. Actually, much higher than 16, because this is 60 years mine life, 20 years mine life, 30 years, 17. I could easily say this is 20 years in total mine life. If we average it out, we have EBITDA 2023 is this. Over 1 billion. So 1.2 billion valuation in a year. That's almost a double. Okay. That was, we don't need this. That was the workshop today. We found another very interesting undervalued, under book value gold mine at a very compelling price. And this is a buy. And I'll see you in the next video.